Hi everyone, welcome to the Jeff Bullis Show. Today with me, Matheus Riolfi. Now, Matheus is the co-founder and CEO of Tint. That is not a car company that tints windows. It's something else. We're going to find out what that is. Before this, he is Director of International Expansion at Turo, which was a peer-to-peer car rental company, and launched the company in Canada, the UK, and Germany. He pioneered the operations, including designing risk management in different stages of the company and sourcing insurance in various countries. He is a licensed insurance broker in all 50 US states, holds an MBA from Harvard Business School and a dual degree in business from the University of Sao Paulo and 𝓬 Business School. He leads a team of passionate and talented professionals who are on a mission to empower any company to embed insurance into its product. And we're going to find out what embedding insurance in its product means. Tint is a Y Combinator-backed startup that provides a no-code platform, compliance services, and capital capacity for innovative insurance solutions. So, Matheus, welcome to the show. It's great to have you here.
Hi, Jeff. Thank you very much, and it's a pleasure to be here.
So, Matheus is dialing in from Las Vegas, Nevada, and was in the Silicon Bay area, but decided to move to Las Vegas, Nevada. Now, Matheus, what was your entrepreneurial journey? Where did it start?
My journey started like very early. So I was one of those kids that always wanted to do some business related things, even from a very early age. So for example, when I was 10 years old, we started a mini printing business. Like we had a HP DeskJet printer. We print some things and sold in our school to our teachers. It was like it wasn't very early in the day. So I knew that I want to be a founder. I knew that eventually I wanted to start my own businesses. And then I went to business school for undergrad. I was a consultant, but I eventually ended up going to Harvard Business School, as you mentioned, because I wanted to launch global businesses and I think there was really no better place than in the US or for technology in the Bay Area. So that's came here, graduated from business school, moved to the US, to the Bay Area, and then I joined this company called Turo at the time, a very small early stage startup that eventually it scaled to multi-billion-dollar businesses and hundreds of employees in the 4 years that I was there. But during Turo, my co-founder and we met and we teamed up to launch Tint to solve one of the problems that we faced when we were working with insurance at Turo. So we saw when we were there that Turo was being a car sharing company, was spending a lot of time and resources in insurance, and it was becoming a mini insurance company behind the scenes. And we saw that that the opportunity that in the future consumers will buy most of the insurance products from the companies they love when they need it. And we saw that future happening, but we also saw how hard it was for Turo to go through this journey. So that's why we eventually end up starting Tint to build what we wish existed when we were working at Turo.
Right. So basically you saw an opportunity in solving a problem that you had experienced at Turo.
That's right. So I always had this idea that I want to start my own business, but I do believe that it's very important that you find a problem that you are very passionate about, that ideally you have domain expertise, and then you have evidence or you're seeing there will be a market for it. And I think that's what I check all these boxes as I was working with Turo, because then we saw how this problem was big for us, and we looked around, we saw there was really part of a bigger trend that was happening in the market. So I definitely saw this as a way to connect my kind of entrepreneurial drive with a real problem and a big opportunity that was available.
So did you do much research about this in terms of the size of the market, like checked out competitors? How did, when you said this is a problem, what were the next steps for you in terms of designing the business? Tell us about that.
Yeah, we talked with companies, all the companies that we believe could be doing embedded insurance. And again, as you mentioned, embedded insurance is a somewhat obscure term for something very simple. Is the idea of getting insurance as part of some other purchases you're doing. So think about when you rent a place at Airbnb, you don't think about it but that transaction comes with insurance. So as part of your, they say $100 a night that you pay to stay in a certain place, a fraction of that goes towards an insurance product that coverage you're buying. And the idea is that if your kids break the TV, if the apartment catches fire, whatever it is protected. There is insurance. You're not out of pocket with that experience. And so we saw in the case of Turo is a car rental or car sharing. So as you rent somebody else's Porsche 911, you're driving it around, things may go wrong, right? You can hit somebody. The car may be stolen while it's parking, whatever. So Turo offers insurance as part of that experience. So that's what it's called embedded. It comes with something else. So it's a much better experience for consumers that if they had to go purchase insurance separately through a different company. So that's why we believe is the future of insurance. So we saw that happening at Turo, and then we looked around. We talked to companies, folks in different companies. We saw the companies like Apple offer Apple Care, which is now a form of insurance product. We saw Tesla investing high in create own insurance products. So whenever you buy a Tesla, you can get insurance from them. So we like Flexport, was one of the biggest names in the shipping space, offering that as part of the platform. We looked around and saw a lot of big companies doing, and they have millions of dollars in resources to dedicate. But we thought that everybody else out there in the market could use a product like Tint and get this access to the same resources in a much less expensive way. And that's how we validated the opportunity and decided to get started.
Right. So in terms of setting it up, you said you are an insurance broker in 50 states. So did you become an insurance broker as part of what you were doing at Turo, or did you become an insurance broker when you set up Tint?
It was when I set up Tint. So during my Turo experience, I had a lot of exposure to insurance as I was buying insurance in different countries. So as we were launching Turo, say in Canada, we needed to go and set up the insurance. So I had a lot of experience as a buyer or as the company that is embedding insurance. And as we decided to start the company, we needed to play the role of an agent or a broker. And that's insurance is a highly regulated industry. So one of the first few things I did was to go get my license, and so we could start transacting the business of insurance. And what is interesting is that I didn't do this from day one, right? So we started, and then as we were researching the market, we found a need for this license. So then I applied after we had customers that were willing to pay for a service that would require my license. And that's why I recommend founders do, because sometimes you can get excited and invest in parts of your product that nobody really cares about, and you may waste that investment of time and money. So wait for customers to pull that from you, to require that from you, and then you make those investments.
Cool. So the next question I have that I'm curious about is, when you are sourcing insurance for a company, because you basically do all the hard work behind the scenes to make it easy for the company to buy insurance or apply insurance or embed insurance. So does the insurance company come in and it's case-by-case basis for every company you do behind the scenes before you embed it? How does that look?
So we have partnerships. So we spend a lot of time and energy meeting different insurance companies or insurance or folks that are willing to finance some kind of risks that are coming from those companies that embedded insurance with us. So we have a set of carriers that we already have pre-agreements with, and with different degrees of control. And also it's a combination of both. Sometimes those are carriers and partnerships we already have, so it's off the shelf and we go. But one of our competitive advantages is that we can enable companies in very creative use cases. For example, one of our companies is this company called QuantStamp, and they do crypto. So they look at DeFi or decentralized finance platforms where you can lend your money to the platform, and they assess the risk of hacks. So say you deposit $10,000 in this platform, and they can protect you against the risk of a hack. So if somebody hacked your money is gone, they will pay you back. And this is particularly important for like hedge funds or institutional investors who deploy sometimes hundreds of thousands of dollars in those platforms. So QuantStamp had this, their customers asking for this product, and we helped them create this. And that's like a very innovative use case. And we do a lot more of the boring, more plain vanilla insurance, like shipping, like car sharing and things like that. But the QuantStamp shows that this is an example where there are not a lot of insurers available to do that off the shelf. So we have to work with them and create a solution that works for the customer.
Yeah. So how many years are you into the company now? How long since you started?
We started 5.5 years ago.
Right. Okay. So what are some of the challenges you found along the way? Like, great to have an idea, but then there's challenges such as we've got to raise money to fund the growth, fund the technology, which typically are the two biggest things, aren't they? So you essentially you need to pay for the technology that supports what you do. So what are some of the biggest challenges you found along the way?
I believe we have the challenge that every startup has. So to your point, raise money is one of them. So in our journey, because of our backgrounds, because of people we knew, it was relatively easy to get the first checks, the first $400,000, $500,000 to get started. But it was very hard to get the next check, then the seed round. So then definitely fundraising, and then it was very hard for some time, then became very easy around the time we got into Y Combinator. So that was definitely fundraising was one. I think growth, finding customers who believe in what you're doing, especially in the early days when you have no validation, no product or case studies, is incredibly hard. I think now we're lucky that we have, and it's on our website, a few case studies from great companies like UShip, 𝓬𝓪𝓻𝓷, and companies like Deal that work very closely with us. And it becomes easier over time, but in the early days, that was very hard as well.
Yeah. So let's talk about the growth strategies. Basically, how did you get customers? And second question from that is, what is your ideal customer? So let's talk about basically, what is your growth strategy? Did you go and knock on doors, cold call? Did you network, do Facebook advertising? How did you go and get your customers?
Right now, we've been using or only using direct sales. So we have a sales team and a marketing team. They are marketing, generating content, helping us increase the awareness, and the sales team having direct conversations with their customers trying to sell our product. In the future, we're definitely going to explore more indirect sales as well, working with insurance brokers, working with consultants and others do it. But again, we believe at this stage of our company, direct sales is the most efficient. And the way we get to those companies is really a combination of cold outreach. Sometimes we try to leverage as much as possible our network. We're lucky to have a very nice group of investors and operators that are involved, not on a daily basis, but involved in our company. And through our personal and their network, we can reach a very broad universe of potential customers. So we try to get those or to get to those warm intros as much as we can. But it's inside sales, direct. That's really our bread and butter. And in terms of our ideal customer, which is your second question, our ideal customer is a tech-enabled company that is now Series B+. So it's a company that's already at product market fit and now is looking to get add-on opportunities to their business. And embedded insurance and financial services in general can be a very good boost to their core business and their profitability. So that's a good time to engage with us. We have customers that they're earlier than that, and a few that are later. But from our experience, this like series venture-backed, tech-enabled Series B to Series D, it's our sweet spot. They can be in any vertical. I think as we covered before, as long as they have a risk that's intrinsic to the core business, like if they're a shipping company, things breaking in transport, they like, it's very intrinsic. It's gonna happen. Like a certain percentage will break. So by offering protection there, they help their customers buy more because you remove a risk, you give them peace of mind, but also can generate more money because they can charge more. So we are vertical agnostic as long as they can have a intrinsic risk that we can help protect.
Right. So the next question I ask then is the ideal customer size. So are you looking for customers that have got 10 million revenue per annum, 50? I'm sure bigger the better, but they are harder to crack on.
Yeah.
So what's your revenue target size for your ideal customer?
Yeah, well, again, if we align with venture-backed Series B, we're talking a ballpark like, starting at a $5 to $10 million revenue, growing fast. I think those are typical great customers for us because then again, as I mentioned, that scale, they're not too large, but they're growing fast enough that we can create meaningful dollars, meaningful return to them. But again, we talked with customers that are a lot bigger than that, a lot smaller than that, and we will try to do our best in a case by case. But like, this is the $5 to $10 million revenue plus is the best spot for us.
Right. Okay, so that's your target market. Your marketing is basically direct, so sales team, marketing, product awareness. So in terms of building the technology to support the business, what does that require? And it sounds like you're not really a tech guy. You're not a programmer, developer, from what I've noticed. So what's some of the tech you've built and what are the challenges been with that? Because sometimes tech can be like a black box if you're not a coder, right? So what's the challenges been with building out your technology? What sort of technology? What does that look like?
Yes, we have, half of our company are engineers, designers, and product managers. So we invest, like we are in the intersection between insurance and technology. So definitely we invest heavy on the tech part. And so being in the early days, like, I think even when we were 6 or 7 people, I was the only business person. So to your point, I don't have a technical background. I know how to code. I'm like, fairly technical as a product manager, but I'm not an engineer.
Yeah.
So up to the employee number 7, I think I was the only business person in the company. So just show you that, and we always index heavily on the technology side. Then our challenge for us is like the amount of things that we need to do behind the scenes. So if I tell you what we do, like, the company just plug protection and insurance into their checkout flows, and you're like, oh, that's so easy. Even the company sometimes think it's very easy, but the amount of things that we need to do behind the scenes, it's very big. And somehow we have to interface with the company's product. So again, we are a feature of their core business. So the APIs, integrations, the connectivities, they need to happen in real time. And we cannot break, because if we break, their product breaks, right? So we kind of had to, from the early days, invest a lot in infrastructure, reliability to always be available. So the challenge for us, the opportunity, I would say, but also the challenge is we need to build a lot of things, like how to calculate the price, how to fix things, like adjust the cases or the claims when something goes wrong, how to keep track of the payments, how to keep track of a lot of money flowing through our platform. So it's definitely a broader scope that I would imagine that most startups our size have to deal with. But no, again, the advantages is this is an opportunity, right? Like if we do that well, it creates a lot of value to our customers.
Yeah. Because the thing is about something that looks easy usually requires hard work. So there's a lot of complexity behind the user interface that is made to look easy. And that's what a good product is, isn't it?
Yeah, as well. Then I think Steve Jobs, I don't know if his original quote, but I know that he said, according to books, that sophistication is the ultimate simplification, right? So it's absolutely right. Make something look easy. There's probably a lot of work and thought that happened.
Yeah. So you mentioned about funding. So getting the first $500,000, not too hard. Next part was hard. Then the next part wasn't hard. In other words, raising money, because once you sort of raise a certain amount of money, then you got no track record yet. So raising the next part becomes harder, but you need the money to grow, to support, to put in the technology, to put in the team, to do the marketing. That's chicken and egg stuff. The last one is when you start to get the track record and the credibility, then it gets easier. So a lot of people, in terms of, I've got quite a few friends who are in a startup. I'm an investor in a startup which is only 10 years in now, 𝓲𝓵𝓵 out of New Zealand. Then there's a good friend of mine, Rob Brown, who's actually the starter of Curb. All of these companies, I've noticed, and one of the questions I always ask is, what's our runway, which is a technical term for how much money in the bank until, if nothing happens, I'm going to burn it and crash and burn. So what sort of runway are you comfortable with? Because I've got guys that are like raising money on the fly every month. I don't know how they sleep at night. Then you've got others that have got like 1 year, 2 year runway of cash in the bank. And we might go to the story of, I think, as I read in one of the articles about you, was that you did have some money in Silicon Valley Bank, apparently. So let's talk about that next. But what sort of, in terms of a startup, what sort of runway are you comfortable with?
I think it's a great question. And give you my answer, but I'd say we have years of runway right now. So I'm not sure if my answer is going to be genuine, but I would say as a startup founder, you need to be comfortable with weeks of runway, right? Like obviously it's your job to never let the company be in that stage. Make sure that you always have, visibility at a minimum of for 18 months, but ideally more than that. But the reality is, if you're too risk averse, meaning you want to many years of runway, that is going to create some other problems in your business in terms of speed, in terms of urgency. So it's good to have this balance of like being long enough so this is not distracting you, and you believe you can achieve the milestones you need to get the next round, but not too long that becomes too comfortable, right? So I think, again, in our case, we raised in 2021, different market there. We were lucky that we raised a very large Series A. So that puts us on the years of runway but obviously, as I mentioned, like you can create we kind of have to keep reminding ourselves that momentum matters and growing fast matters, even if you have a long runway. And at some point at Tint, I think over 2019, we had like 2 months in the bank. And most of the startups that I know personally from founders, they're very successful, friends and folks that I follow their journey closely, they all at some point in time got close to the 1 to 3 months of runway, or folks that do not know if they can meet payroll at the end of the month. That is not ideal, but it's more common than we think, because you always see the PR side of story. You don't see the things that go behind the scenes.
Yeah. And it's a very interesting thing, because it's this sort of sweet spot, I suppose, to have enough tension to keep you motivated, because you want to make sure you meet payroll. And you also want to raise enough money to actually fund the technology and also fund the growth. In other words, sales and marketing. And it's really, and a lot of companies, especially as copycats emerge, so they end up being in what I call a two-armed race. The battle for market share and the battle for technology. In other words, if you've got better technology, allows you to scale, then that's a competitive advantage, and also for market share. So at the end of the day, quite often in any market, you end up with the top 2 or 3, and then the rest are fighting for scraps. So how important is that in terms of that marketing share arms race?
Yeah, I think that depends on the market, right? Like if it's a market that we saw a few examples like ride sharing or delivery. There are markets that are growing very fast and there's very little differentiation between players. Then I agree with you. Those are markets where it is a race to grab market share, where companies will burn through billions of dollars if required. I think in our case, embedded insurance, it is a consensus that this should be a multi-trillion-dollar market, given that insurance is a multi-trillion-dollar market, and this should be have a very significant share of insurance in the future. So everybody has a line of sight in a multi-trillion-dollar market, which is great. But how is the market already at the stage where it is kind of crazy and the answer is probably not. I think our market is still relatively early. So there are a lot of an education and kind of working with customers. There are many companies building solutions in this space. So there is a race, obviously. But I would say that investing faster, burning faster, it's not always going to bring the best return in this market. So I think that again, as founders, we also need to feel a little bit or understand what's the stage your market is at, and then deploy the resources accordingly.
Yeah. That raises a very interesting question about what we call lazy venture capital money, in the sense that you've got so much money in the bank that you go and do a lot of stuff that really is a waste of money, such as, you go and get the best, floor in San Francisco, put an office in there, it's all flash. We've had a lot of stories of companies burning through $500 million, $1 billion in a matter of years or months. So that's the interesting thing, isn't it? So, and that's the case, is you're playing with other people's money. So you've got to be cognizant of the fact that you are using other people's money and be responsible about that. So, but it's interesting to watch the different strategies. Lazy money, because there's too much of it, versus smart money that's actually a little bit, you're on a shorter leash and you're being watched by the fundees or funders. So are you very aware of your responsibility as a founder about that?
Yeah, absolutely. And again, we are very judicious with the money. Again, as I mentioned, we raised a large Series A. We still have most of it on the bank. We have a low burn because to your point, to me, every dollar you spend that doesn't have an ROI, that is not bringing return to the company, you're destroying value. And what I disagree a little bit with what you said about other people's money is that it was other people's money, but now is your money, right? Now is the company money. And as the founders, you have probably the largest shares, stocks or equity in the company. So from that point, when it becomes your money, you're actually destroying your value more than your personal value, your employees' value, your team's value, more than you're destroying the venture capital value. Because the VCs, they have hundreds of millions of dollars of funds. They are diversified anyway. So if you lose all their money, they'll be sad, but it's part of their model. They know that the majority of companies of their portfolio is not gonna work, and the few that will pay for everybody else. So I would argue that when the dollar becomes the company's dollar, it changed the game, right? Then it becomes the company problem more than becomes the investor. problem. And that's kind of how I run Tint, and that's kind of how our team runs. And we are like, no, we won't get the flashy the flashy place in San Francisco just because we have money in the bank. You know, me moving to Las Vegas is a good example, right? Like it allows the company to pay me less as a CEO because I'm living in a lower like cost of living than if I was say in San Francisco. So you know, it would be very easy for Tint to just double my salary and life would go on. But anyway, those are small things that show you how we're very kind of focused on creating value, high ROI spend as a startup.
Yeah, which is great. Now, the other thing I wanted to find out is, number one, will you be going back to the market to raise more funds? And number two is, maybe the second question we need to ask first, but with the rising interest rates, inflation, there's been a withdrawal of investment in startups. So going to market, raising money's got harder. So trying to raise money's been really difficult the last 2 or 3 years. And different companies have different ways of raising money. I think one strategy that's happened is the safe note, which is raised with essentially internally with the existing investors rather than going out into the market. Are you seeing that change recently, the ability to access capital in Silicon Valley and beyond for startups? Is it getting easier, or is it still very hard?
So we have not been raising since 2021. And again, as I mentioned, we have a few years of runway. So I do not believe we're going to go raise anytime soon either. So I would say everything I've seen is more like a second hand since we're not out there talking with investors as much. From what I heard from other founders, is definitely harder. So a lot of the excesses of the 2020, early 2022 disappear. So we're back to what venture capital used to be. It takes longer to get rounds done. Valuation are lower, so companies have to do more with less money, and that makes sense, right? I think at the end of the day, I don't see that as a problem. I see that more as a correction of a little bit of kind of excess that happened in the market.
Okay, so let's go to your own story of risk that luckily you avoided. Silicon Valley Bank. Tell us a little bit about what happened there. Because everyone thought Silicon Valley Bank was a sure bet and was safe as houses, as we say in Australia. And it really wasn't. So tell us a bit about your experience with the Silicon Valley Bank and your exposure to risk.
Yeah, so we had a Silicon Valley Bank as our bank from day one. Again, a lot of founders in the Valley or really anywhere in the United States worked with them because they, at the time when we started in 2018, they were really the only option that could give you as a startup, like, easy, fast access to your bank account, corporate cards and things like that. So for a long time, they were the only bank that we bank with. And they had our funding or our funds for a long time. We were lucky enough that we, a few months in, and we didn't know about their troubles, but we were introduced to this company that could leave our cash in treasuries and pay us of whatever 5%, whatever is the number, some interest. And we decided to move most of our money to that company, so our money will be working for us. So we had about, now the times the crisis happened, we had about like 10-15% of our runway for like more I wouldn't say monthly, but then more like operational experiences in Silicon Valley Bank, and everything else was in this treasure. So we were not like one of those companies that were like, they could eventually die. We would have survived. But I'd say, 10-15% of your revenue, it's still a lot of money. So there was really a few days that we were very anxious, and especially the speed that it happened. And as we're part of the Y Combinator community, and then over there, like I think the number was like over 30% of the YC companies of like, 4,000 companies they have wouldn't have money to run payroll if
Yes.
Silicon Valley had gone bust. So this would be really a catastrophic impact. So even though we will lose 10, 15% of our runway, I'm sure there'll be other effects in the market that will trickle down back to all startups and back to us from investors losing their money, whatever it was. So I'd say it was definitely it was like a few days of a lot of tension inside and outside the company, and people trying to figure out how to get their money out and what's gonna happen. So luckily the damage was controlled, right? Like as we all know.
Yeah.
But those are one of the things that as a founder, it's completely outside of your control and it can be existential. So it's like, it's very scary.
Yeah. So did you get all your money back?
We did, yeah, because again, I don't know of people who didn't, because eventually the Silicon Valley Bank got bailed by another bank who honor all the deposits and everything. So I do believe we did get all the money back. I think there was 3 or 4 days that it was frozen, but after that it became liquid again. I do believe we have still some part of the money in Silicon Valley Bank now under or around the insurance limit. So I think everybody learned their lesson of not leaving uninsured money in banks, however strong they may look like. But yeah, there was definitely a good learning, as painful as it was.
Mm. Yeah. So basically, you had to make sure you're going to make sure that you're protecting your risk while you're protecting customers' risks as well. So yeah. So this raises my last 2 questions I want to ask you. Number one, what brings you joy and happiness? I'm not talking having a drink at the bar with friends, but what brings you deep joy and happiness that you just makes you thrive? What's that for you?
Yeah, on the personal side is my family. So I'm lucky enough to be married to like an amazing wife who's also a founder. So also going through the same pain points and experiences and roller coasters that I am as a founder. And we have a 3-year-old daughter. And I think really they're the joys of my life, because they kind of remind me that despite all this craziness that goes in running a startup and trying to change really an entire industry like what we do, this is what matters, right? It's like your people around you, your relationships, people who love you. So yeah, that brings me deep joy to try to spend as much time as I can with them.
Right. And in business, what makes you curious? In other words, as you're a creator of businesses, does that bring you joy and happiness?
It does. So on the professional side, the idea of now bringing something to the world that wasn't there, and especially like I'm trying to do something ambitious that impacts, improves lives of thousands, hundreds of thousands, millions of people, that brings me a lot of joy, because I find that to be very meaningful and justify putting all this energy and time that we put in doing work. And yeah, and I think I believe in it. It's easier to say that, but no, I believe that money to me is not a good driver. There are easier, faster, better ways to make money than being a startup founders for sure. Like working finance, like that many, or being a VC for that matter. But I think I really get a lot of like fulfillment from building things, from like creating things, exploring, and that creative energy like really makes me happy.
Yeah, that's great to hear, because I believe that as humans, I think being creators, I think brings us some of the greatest joy, along with the standard things of obviously human relationships, which was a Harvard study done 80 or plus years ago. Now, the last question I'm going to ask you is, usually we don't learn from comfort or happiness. We learn more from challenges and pain and suffering. And what I mean by suffering is not, terrible suffering. I'm talking about the challenges. So what are some of the challenges that you've learned the most from over in your experience as an entrepreneur?
I would agree with that most of the learns, or the deepest learns, come from times where like you hit a wall and then you have to like a little bit reinvent yourself And you know, that's painful to your point. I think in my case, it's been like the period we went through between the two fundraisers, as I mentioned, that we were trying to find a path. Like we always knew the vision, we always knew the grand ambition that we were going towards, and which is exactly the same that we have today. But it was a bit of a hard time finding a path that would lead to convince us and others that like, hey, that can be, you guys can create a venture-backed startup out of it. And that process that took us a good like 2.5 years of going through that struggle and not quitting, right? It's about the time my daughter was born. So I found myself with like this baby at home and to figure out my startup. So there was definitely a lot of like personal, kind of hard personal journey through that. But finding ways to go through this and not quitting, building that grit, that resilience, I think it's something that, you know, we're gonna leave. We're gonna take it with us for the rest of, as I say, my co-founder as well, take with us for the rest of our lives, because from here, you know, you learn how to be in those situations and don't get desperate. Just keep going. Just keep, you know, putting your heads down. And I think that's kind of, at the end of the day, I believe this is the most important trait that a founder should build. A lot more than being smart, a lot more than being visionary, is just being able to just keep going, have the grit, and then you learn from, to your point, pain from setbacks and challenges you have.
Yeah. So really what you're saying is one of the things you learned is persistence.
Mm-hmm.
Yeah. And the thing about most overnight successes is they aren't usually overnight successes.
Yeah, never overnight. That's the PR version of it.
Yeah, exactly. That's the PR version of the story. And typically, I think the thing I've learned is that playing the long game and not worrying too much about the short bumps, just treat them not as failures, but as learning opportunities. And I think for me, when I've done that, is that then the problem doesn't seem so big. It's seen as an opportunity. It's not that you welcome challenges or invite them, but you welcome them as an opportunity to grow. And I think attitude is really important in business and in life.
Yeah, I couldn't agree more.
Yeah. So, Matheus, thank you very much for your sharing your story and also for revealing what's under the hood at Tint. And I look forward to hearing more about your ongoing success. It sounds like you're sleeping at night, which is great. And you're making sure that customers are being protected from risk. And you're making a difference. So thank you very much for sharing your stories and experience, and look forward to catching up in real life one day, maybe in Las Vegas.
Sounds good. Let me know when you're here for any conferences or something else. But thank you so much, Jeff. It was a pleasure speaking with you.
Thank you, Matheus. Thank you.